Welcome back, everybody. Good to have you to the first real estate market update for the Greater Milwaukee Area, this time January 2025. If you're thinking about moving this year, then you want to watch this. This is the first time we have a full data set for 2024, so I can show you how the Milwaukee housing market has performed last year and how it compares to previous years and how this is going to set the stage for 2025. We're also going to take a look at the big trends to watch this year because there's plenty of shifts and movements in the market that will really determine which direction things are going. So we'll take a look at that. And if you never quite knew what an inverted yield curve is and how that impacts mortgage rates, then give me 2 minutes at the end of the video. I promise I'll fix that. If you want to get a hold of me, you have my contact information on the screen here and also in the description below. Most people just prefer to send me an email, but you can also go on my website, onpointrg.com, and book a 15-minute phone call or Zoom call directly there. Pick a time that works for you, and then we'll hop on a quick chat and talk about your personal situation, your personal plans, and how we can strategize and fit this into what's going on in the market in 2025. All right, with that, let's get going. Here's the latest data from the MLS inventory in December. So this is specifically the month of December. Is up 20%, so that's great, but still very low inventory. You have the historic numbers below. Market is very, very small. Only 1,500 units have closed. Days on market is getting longer now. In spring, summer, we were around 5-6 days on market. Now we're up 17, which is kind of what you would expect for this time of the year. Things are just slowing down a little bit. Median sold price is up again, $323,000 now in December for the median home that sold, and that's up 11.4%. And that is really remarkable. I put it here, December was the second month with double-digit price increases. So if you remember last month, I said, well, this may have been a fluke. See here a double-digit increase, but now this is the second month in a row. So now I'm going to pay attention to this and we'll see what is happening. Normally, November and December are lower in terms of the increase compared to what we've seen prior. So usually 2% less, and now we're up. So this is interesting. At the same time, 1,500 listings have expired end of December. So this is a phenomenon we see every year. Not every house sells. Either it wasn't staged correctly or priced correctly or didn't look good or the marketing was off. Whatever it was, it didn't sell, and a lot of listing contracts expire by the end of December. And so you see inventory dropping by 1,500 units overall around this time of the year between the end of December and January 1st. It's just gone. A lot of them come back, repositioned, maybe with a better agent, etc., and then we'll be selling in spring. So while some fail, some others attract multiple offers. We have seen that in December. We have closed, I think, 7 deals in December, and we had a number of really good ones, but we also had a few competitive negotiations in there. Another very interesting phenomenon we observe every year around this time, and it's really happening like clockwork, is that buyers and sellers are absolutely not on the same page. So what's happening? Buyers are already out. It's after the holidays. They've been talking about buying a home in spring, so now it's January. They're looking on the internet, but there's nothing out there because we just lost 1,525 listings to expired. Sellers, on the other hand, they're thinking about spring. So they're in no hurry. They want to wait until the grass is green and the flowers are out and the house shows really pretty. So there is a major disconnect, and that is kind of setting up the stage as we're going through January and February. Buyers are getting more and more anxious, and then finally some sellers are coming on the market. I always equate this a little bit jokingly to a party where you have all guys at 8 o'clock and at 9 o'clock and they start drinking and there's no females there, and at 10 o'clock 2 ladies show up and you bet they're getting some attention. So that's kind of what's happening in our real estate spring market, and it works really like clockwork. Every year we're seeing this. All right, let's take a look at the numbers from last year. So we finished the total year with the median sales price of $330,000. So this is now for the full year. And if you look at the trend here, this is really a relatively stable trend, relatively predictable. And we added another $25,000. That comes out to about 8.2% on average in increase on a median home. Now, when you look at the price increases, 8.2% is kind of like middle of the road. We had a crazy year in 2020. Interestingly enough, we didn't follow the rest of the country when every other market in the US went nuts in 21, 22. We actually were a little bit more restrained, I would like to say. And now we're just following the trend. So the increase of 8.2% falls right in line, basically what we have seen for the last 5-6 years. Inventory is interesting because we only had 29,000 listings for sale last year. And just to give you the context here, that has been steadily declining. So we're lacking inventory. We just have not enough houses for the number of people that we have. We have seen a little bit of a turnaround here in 2024, and I'm hoping that we're going to see more inventory in 2025. There are a number of reasons for this. And it's not going to be a huge change. You can see that these changes are happening very, very gradually. Nothing is jumping here like crazy, but I think we might get a little bit more inventory in 2025. Before we get into some questions that I always get when we're talking about this, let me show you how the housing market segmentation in Milwaukee has changed over the last 10 years. So when you look at this chart, you can see here the price segment from 100 to 160, and let's add this one in, 160 to 200. So this one plus this one is $100,000 to $200,000. 10 years ago, this used to be by far the biggest market segment in our area. And then it kind of comes down here and there's not much over $500,000. Fast forward, let's take a look at 2024, total shift in the marketplace. There's almost nothing for under $200,000. The biggest segments, first-time homebuyer segments, are now 300 to 400 and 400 to 500. If you take these two together, that is by far the biggest market segment. You have here 500 to 650. A lot of the new construction is happening in that space. That's oftentimes too expensive for first-time homebuyers. It's a little bit of a stretch. And then you see new construction also spilling here into this range here. And then there's not that much volume over $1 million, but it is more than we used to have. Now, did my home go up 8.2% in value? That is the question, or maybe a wrong assumption that a lot of people are having when they see the data. 8.2% appreciation. No, not really. It depends where your house is located. So it is different if you are in Whitefish Bay or in Germantown or in West Allis. And then also a major factor is in what price range are you? Because we've seen the most of the home price appreciation here in that very competitive segment here between 3 and 4, and then 4 and 500. That's where the bulk of the appreciation is happening. If you own a home that's $1 million or $1.2 million, no, that did not go up $82,000 or 8.2%. Maybe it went up $20,000, $25,000, but it's not evenly distributed across all the price segments. So we have to take a look at your house individually to know exactly what is going on in your local market, and then do a market analysis and calculate the value. Will home prices come down in 2025? Home prices have gone up steadily over the last 10 years. That lets a lot of people think, well, if it goes up like on the stock market at some point, it needs to come correcting down. The real estate market works a little bit differently than the stock market. And I have to tell you, there is nothing on the radar right now that would be able to derail, that is strong enough to derail the current dynamic that we have. So as far as I can tell, 2025 will be some sort of a version of what we have seen in 2024 until something totally unpredictable happens that nobody could have expected. The next follow-up question that usually comes is, what's driving home values? So a lot of people, I don't think they think a whole lot about it, but they may jump to the conclusion that it's really the sellers that are driving home prices up, but that's not necessarily the case. Take a look at this year. This is the sale to list price ratio. And what this chart is telling you for the last 12 months is that for the biggest part of the time, buyers have made offers over 100% of list price. So it is really the buyers that are driving up the list price, because on a nice listing that's priced well, I have to add, you typically have more than one buyer interested, so they're competing with each other and they're driving up the list price. And we have seen in hot markets 5%, 10% over list price during the spring and summer market. And this is what manifests here in this chart. Of course, now December. Typically for the December market, we have seen that ratio coming down. But this is really where the price increases are coming from. When we look at sold prices, In red, you have here what has actually closed. So this is after people negotiate. And I was already surprised to see how steadily that they have been holding up here. The blue line is giving you new listings. So this is what sellers are coming on the market with. And this is really interesting. You would not expect normally a jump up here between November and December. And that ties a little bit up with what I told you on the first slide about 11.4% home price increase in December. So we'll have to keep an eye on this trend because this is not typically what we would expect for November and December. Let's take a look at inventory and supply. So this is new listings as they're coming on the market. And as expected this time of the year, that is dropping down. We'll probably see an increase in January and then it slowly starts ramping up. So if you're wondering when is inventory coming on the market, this chart should give you a reasonable answer. We expect 2025 to be a version of 2024, so it will follow somewhat this path here, and by April, May, we should see maximum inventory for the spring market. All right, let's take a look at the economy. What can we expect from mortgage rates? You probably remember that the Fed did cut rates in December by another quarter point. The caveat was that they also said they're only going to cut rates twice in 2025 and not 8 times as they said previously. This is a great chart, I think, because you can see here how inflation ramped up and then it came down. And here you can see how the Fed was first telling us, no, it's just transitionary, don't worry about it. And then inflation went really high and then they started jacking up interest rates. This is what happened here. Then they held them stable for a while and now they're slowly coming down. Now, the interesting part is how is it possible that the Fed is reducing rates and at the same time we see mortgage rates are going up? And that's the part where I have to take you a little bit over to the yield curve as promised, and I'll try to keep that in 2 minutes. So when you think of US Treasury bonds, think of it a little bit as a CD at the bank. If you go to the bank and you give them your money and you put it into a 6-month CD, you get a certain interest rate. That's the yield. If you put the money into a 12-month, into a longer CD, then you get a typically a little bit higher interest rate. So a US Treasury bond is the same thing. The longer you commit your money, the higher is the interest rate. And what the interest rate is gets determined in the financial markets via supply and demand. And by the way, you don't have to be a country to invest in US Treasury bonds. You can do that as a private individual, and you may not know that the interest rate that you're collecting is actually tax-free in most cases. So this is kind of in a normal market what the yield curve looks like. The longer you're committing your money, the higher of a return you're getting, the higher of a interest rate you're getting. Now, when the yield curve is inverting, it looks something like this. This is when the market says the short-term risk is high because we fear there's going to be a recession next year. So we want to have a higher return on our short-term money. And this is an inverted yield curve when the market basically collectively is expecting a recession. And we've seen that over the last years. There's some other scenarios, but they're not that relevant. So what's happening now is that the yield curve is starting to normalize. It is disinverting. So the last few years, we had an inverted yield curve. You can see the red line here. A year ago, the short-term yields were higher than the long-term yields. And now it's starting to correct and move again into this direction where the blue line here, that's today's treasury yields, are higher. And the 10-year real yield is a very important mark because from an investor point of view, if you want to invest your money conservatively, long-term, low risk, then you have the choice of investing it into either US Treasury bonds or into US mortgage-backed securities, and they run about for 10 years. So it's a similar time frame, but investors are saying if I put my money into homeowners' mortgages, the risk is a little higher than US government treasuries, so I want the risk premium. I want to have on the 10-year note, I want to have about 2.5% more. And this is how we end up with mortgage rates. So if it's good news for the economy, that means that the yield curve is normalizing. That means this is going up here. That means mortgage rates are going up. What would need to happen in order for mortgage rates to go down? We would need to have a negative outlook on the economy. Then the yield curve would come down in the future, and that would also mean that mortgage rates would be coming down again. Now, what is influencing the 10-year treasury yield? There's a lot of things that factor into the capital markets. Here's just a few of them. So anything from debt to deficit to oil to inflation, tariffs, trade. geopolitics, GDP, global economy. So a lot of things go into that, and you can forecast 12 things correctly. If you're wrong on 2, then your prediction will be off, and this is why it is so difficult to accurately forecast mortgage rates, because they really get decided in the capital markets, not by the Fed. All right, so what does this mean for us, for home buyers? So this is a calculation for a typical mortgage with a 7% mortgage rate. I've used the 323 median home price that we have right now with the 10% down payment. It's kind of average. You know that a lot of first-time home buyers actually use a 5% down payment, but you can go 10, go 20. So in this case, with the 10% down payment, it gives you a monthly principal and interest payment of $1,934. Then you have property taxes, you get homeowners insurance, and because you didn't put 20% down, you also have to pay PMI. So that's $151. And that gets you to a total of $2,516. Now, if mortgage rates would be going down by the end of the year to 6%, which is still what a lot of banks are forecasting, that would give you a savings monthly of $191. And if at some point we're getting to 5%, that would be another $183 that you would be saving. By the way, I'm using a US mortgage calculator here. It's a free app you can download. Nothing particular about this one. I just like using it. So if you want to play around with that, then you can go to your app store and download this as well. All right, that gets us to what can we expect for the next few weeks for the Milwaukee market. I would say, first of all, there's still opportunity out there. There's still 2024 listings from last year where you have sellers that are getting slowly fatigued and ready to make a deal. So some opportunities there. New listings will be very slow in January. There is not going to be coming that much. Mortgage rates should be right around 7% based on what we are currently seeing. So there's no major reduction in sight right now. But we have a few things to watch for. And so the first thing here is inventory, new listing supply. And we're talking a lot about rate-locked sellers. So what this basically is, you have a lot of homeowners that are currently financed with the mortgage that is very low, let's say 3% or even less. So if they would put the house on the market, that seller also needs to live somewhere. So most likely about 72% of the time they're going to buy another house. And they don't want to do that with rates currently at 7% high. So that is what caused so many sellers to not put the house on the market in the last years, and we will see how much that rate lock effect is going to impact inventory this year. The next thing obviously is going to be mortgage rates. As we've just seen, every percent swing in the mortgage rates is going to change payments for about $200. So of course that is influencing behavior of buyers and sellers. Then we have to wait to see what the new economic policies from the incoming administration and how that is impacting the economy. And we also want to keep tabs on what's going on with Milwaukee prices. We have seen that in November and December. We've seen double-digit price increases, which is not typical for November and December. And that makes me pause and think, what are we going to see here in January? So I'll definitely keep an eye on that. In the next 2 weeks, we will get a lot more clarity on some of these issues, and we'll see in which direction things are going. So if you want to stay updated, consider subscribing to the channel. I'll have the next February market update ready for you in just a few short weeks, and then we can see how the spring market is shaping up. And if you know somebody who could benefit from this information, consider sharing this video with them. If you're thinking about making a move this year and you're considering selling and buying, then there's probably one question on your mind, and that is, how much is my home currently really worth? Because it makes a big difference if you're buying a home with $50,000 down payment or with $250,000 down payment. So this is why you want to have an accurate number, and you want it to be calculated and not a guesstimate. In order to calculate fair market value, you have to look at comparables and put a CMA together, which is a free service that I'm happy to provide. And there is no expectation and no obligation. So if you just look at the number and say, you know what, at the moment we're not going to do nothing, that's perfectly fine as well. The other question that you might have is, should I make improvements? More often than not, I have to talk sellers out of making expensive improvements like a kitchen remodel, because it just does not give you a good return on your money or on your time in order to make that happen. So if you really want to optimize the sales price, then we have to be very careful where we are spending your money and your time on. And if you're looking into buying a home, we have a lot of free resources on our website. You can go to onpointrg.com. and download one of our guides. For example, we have a first-time homebuyer guide that walks you through the entire process of buying a home in Milwaukee here with a lot of tips and tricks that are specific to our market. We also have a seller guide with a relocation guide, and you can request access to the MLS. My contact information is here on the lower left corner, and you'll also find it in the description below this video. That's all I had for you this month. Thank you very much for watching, and I'll see you next time.